Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for Friday, March 5th, 2021. And we will also be going over the highlights of what has happened in the stock market so far this year. The first chart that we will be looking at is this weekly candlestick chart of the S&P 500. And for this analysis, guys, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I'm a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. So the S&P 500 was up 81 basis points this week, and we closed at 3841.94. So if you just looked at this chart, which again is a weekly candlestick chart of the S&P 500 that starts at the beginning of September 2020, I just wanted to really focus on the last few months so you could see what's going on. But if you just looked at this, it looked like, ho-hum week, nothing really to talk about. But as you'll see in the next chart, it's been extremely volatile, and it was a pretty crazy week. Now, the previous 2 weeks, right, this is this week right here, and we closed kind of right in the middle of the trading, so there's just, it's really hard to see that candle there. But the previous 2 weeks in the S&P 500 were negative, and the all-time closing high week so far happened on the week ending on February 12th, where we closed at 3934.83. So that is the all-time closing high. And then again, you can see we closed lower the next 2 weeks, and then this week again up 81 basis points. Now, before we move on to the next chart, though, I want to point out the 3700 to 3725 level, guys, because this is extremely important, which is why I have these blue lines in here. You can see this week, it's pretty hard to see on this candle, but you can see we checked back to just right at that 3725 level during this week. That was the weekly low. We got just below that, and I'll give you the exact numbers here in just a couple minutes. But this 3700 level where we pulled back to at the end of January, that really, this area, this 3700 to 3725 is kind of the line in the sand where we really need to hold that level, because if we don't, then further downside is definitely likely. The next chart that we're going to look at is an hourly candlestick chart of the S&P 500 that starts on December 31st. So I wanted to include this so we could see where the S&P 500 closed for 2020. And also this chart includes every hour of trading in the S&P 500 so far for 2021. Now, let's start over on the right side of the chart. And again, you can see the last hourly close on the S&P 500. And again, we closed at 3841.93. Now, on Friday alone, the 5th of March, we were up 1.95%. So we had one heck of a rally today after selling off yesterday on March 4th. And you can see here that we hit the intra-week low of 3723.34. I just ballparked it on the last chart at 3725, but this was the week. This was the lows of the week, and this happened right here on this hourly candle on March 4th on Thursday. And this was after the sell-off from when Jerome Powell, Fed Chair Jerome Powell, was speaking, and you could see this rapid decline that we had there on March 4th yesterday, and then of course today we bounced back. Now, the real important trading range where the S&P 500 has been operating for a good portion of this year so far has been this 3820 to 3860 level. Okay, so we finished kind of right dead center again at 3841.94. So as long as we stay in this 3820 to 3860 range, we're probably going to be okay. All right, but let's go back to the beginning of the year to kind of walk through what has happened, because I think it really helps to get a complete picture of where we've been and this sell-off and what has really happened. So we know that we closed on December 31st at 3756.07. The very first trading day of 2021, the 4th of January. We sold off and then rallied from there. Now we hit our 2021 lows so far of 36.6271. That was the intraday low on January 4th, the very first trading session of this year. And so just kind of keep that in your mind there, 36.6271. Hopefully we won't see that number again anytime soon. And then we rallied up to this 38.20 level where 38.20 acted as overhead resistance. I just have that abbreviated OHR. So we had overhead resistance at 38.20 for several days in January, sold off just a little bit, and then finally broke through that and then got up to this 38.60 level where 38.60 then acted as overhead resistance for several days in the kind of the mid to the latter part of January. Now, we had a failed breakout above 38.60. You can see this 1 hourly candle. Again, every candle on this chart is an hour's trading, but you can see here where I have this circle drawn, this was a failed breakout above 38.60, and then of course the market sold off from there, and then we pulled right back to this 3,700 level, this blue line here. Okay, and I pointed that out on the previous chart that this 3,700 level is extremely important, and you can see why. We checked back to this area, and then on the hourly candles, you can see we closed just barely above this. And this was on the last trading day of January. And then during the month of February, we started to make some progress, right? And we got back above the 38.20 level on February 2nd. And until this week, we only had one, and I'll go back over the rest of the chart here, but I just want to point this out. We had only had one hourly close beneath 38.20 since February 2nd, since we got back above this area. So from February 2nd, we got above 38.20, then quickly got above 38.60, and then we started to trade above 3,900, as you can see here. But what you can see is, and I pointed this out on my video on the 19th, if you want to go back and check that out, but we were forming a head and shoulders reversal pattern on the hourly charts. You really can't see it on the dailies, but you can clearly see here, and I have this annotated, and again, you can see this same chart back on the 19th. So go check that video out if you want. But here's the left shoulder, here's the head, and here's the right shoulder. And I pointed out that on Friday the 19th that if we closed beneath this 38.95 neckline anytime over the following week, that that would confirm that this indeed was a head and shoulders reversal pattern. And that's why I annotated Monday right here, because you can clearly see that when we opened up on Monday the 22nd, we broke down, and that confirmed that this indeed was a head and shoulders reversal pattern. We broke that neckline, sold off, went right back down to this 38.20 level. Now, we didn't close beneath it on the hourly closes, but you can see the tail of this candle dipped down beneath this 38.20 level for a few minutes, and then we had this rally attempt that failed. Now, the other thing that's happening here is we have a series of lower highs. Okay, so we've got lower highs. Part of this is also part of the head and shoulders reversal pattern, but you can see this rally attempt here stopped just slightly lower than the right shoulder of that head and shoulders reversal pattern. Again, we once again sold off to this 38.20 level, and then the very last trading day of February, we had this 1 hourly candle that closed beneath 38.20. And again, that was the first time since February 2nd that had happened. Well, first trading day in March, we got right back above here. Looked like we were going to be okay. However, we once again failed. So we had another failed rally attempt, right? And again, we've got this series now of lower highs. That is a bearish sign. And then the market once again this week rolled over, right? And we started to close beneath the neckline, and then again below 38.60. And then on the 4th, early part of Thursday, it looked like we might be okay. We had this 1 hourly candle that closed beneath 38.20. We got back above there, but as soon as Fed Chair Powell started to talk, and there was some commentary, I'm not going to get too deep in the weeds here, but there was some commentary about rising bond yields, falling bond prices, and inflation, and the market participants and the algorithms did not like what Fed Chair Powell had to say, and that's why we see these two really negative hourly candles here, and that brought us down to our weekly low, which happened on Thursday at 37.2334, as you see right here. And then today, the market snapped back quite nicely. And by the end of the day, we got back into this 38.20 to 38.60 pocket. So as long as we can continue to close, next week above 38.20, the worst is probably behind us. However, we do have this series of lower highs since we hit our all-time intraday high, which was 39.50.43, and that was back on February 16th, which was, again, part of that head in this head and shoulders reversal pattern. So the intraday high on the 16th, the all-time high so far in the S&P 500, 39.50.43, and again, that was back on February 16th. But from that point, we've been making a series of lower highs. So, do we stall out next week somewhere, below this, or can we power through and start to close above these highs and then move, hopefully, over the next few weeks into this, 39.50 plus area and start getting into some new all-time highs? Now, that is a very a positive, very rosy scenario, guys. There's still a lot of negativity in these markets, so I'm not trying to say that that's what I think will happen, but that's what will need to happen if we're going to pull out of this funk that these markets have been in. So it's completely possible. Nobody knows for sure. What we do know here is, at least for today, we closed back above this 38.20 level, which is extremely important. And we've only had really about 2 days of trading, 1.5 days of trading, where we were below 38.20, and from this point going clear back to the first part of February. So we just have to keep our fingers crossed that this is as bad as it's going to get for now. But if we start to roll back over and then at some point start to close below 3,700, both on the hourlies and dailies, we should expect at least another 5% downside from this 3,700 level. So the markets have been extremely volatile as of late, but the good news is, for now, we're back above this 38.20 level. We'll keep our fingers crossed that we can stay above that level next week. Want more charts? Want access to proprietary market information? Want to minimize the likelihood you will experience catastrophic losses in the market? Watch the balance of this video to learn more. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors. And what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors. And what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how simple market signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then, of course, the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would get in the habit, I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, the emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule. And the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition. So whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least one or two emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.